Click the bell icon to get latest videos from Ekeeda.
Hello friends, let us do one question on single entry system where various adjustments are asked along with one important adjustment of purchase of government bonds during the year. We are required to calculate proportionate interest on this investment. Let us read question. Mr. Suhas, a small trader, provides you following details about his business. Debtors, asset. Creditors, liabilities. Computer, asset. 10% government bonds, asset. This is investment. Bank overdraft, liability. Motor van, asset. Furniture, asset. Stock, asset. Cash in hand, asset. Bills receivable, asset. As on 1st April 2011, we have the values which will be used for preparation of opening statement of affairs so that we can find out opening capital as on 1st April 2011. Second column we have values as on 31st March 2012. With this we can prepare closing statement of affairs to find out closing capital at year end. Let us go through the adjustments. Additional information. On 1st October 2011, he withdrew 40,000 for personal use. This is information of drawings. This 40,000 will be added while preparing statement of net profit and loss. Next, charge interest on drawings rupees 2,000. This amount of interest charged on drawings will be income for the business. Here we have direct amount 2,000. We are not required to calculate interest on drawings. This will be income. So it will be added while preparing statement of profit and loss. Next, he had also withdrawn one more drawings rupees 30,000 for rent of his residential flat. So for his residential flat, amount payable to landlord he has paid from the business. This is cash drawings. While preparing statement of profit and loss, this amount will be added. Next, depreciate furniture by 10%. Furniture opening balance is 10,000. Closing balance is also 10,000. Amount of depreciation they have said 10%. So it will be 10% of 10,000. So amount of depreciation here it will be rupees 1,000. This amount is an expense. This will be deducted. And write off 2,000 from motor van. Writing off assets is another kind of depreciation. Motor van we have 80,000. Depreciation amount directly given 2,000. So we are required to deduct this amount. This is also expense. 10% government bonds were purchased on 1st October 2011. Here we have information of 10% government bonds. Opening, there is nothing. That means at the beginning of the year, this investment was not there. This was purchased in between the year. The date is given 1st October 2011. That means from 1st October 2011 up to 31st March 2012. October to March, there has been 6 months since purchase of this investment. So we are required to calculate interest. Interest is 10% as it is included in the name of investment 10% government bonds. It indicates that it is carrying interest at the rate of 10%. Amount of investment is 10,000. Investment amount is 10,000. Rate of interest 10%, 10 by 100. Accrued interest for 6 months, 6 by 12. So amount of accrued interest we get rupees 500. This is income for the business, so it has to be added. Allow interest on capital 10% per annum. This will be calculated on opening capital. This will be kind of expense. It has to be subtracted. We don't have the balance of opening capital at the beginning of the year. We are required to prepare statement of affairs to find out opening capital. Then we can calculate 10% interest on it. Rupees 2,000 is written off as bad debts. Closing debtors are 50,000. New bad debts 2,000 is related to this 50,000. From 50,000, if this 2,000 goes written off, cancelled, balance debtors will be 48,000. This 2,000 will be recorded as an expense, subtracted. This 2,000 will be expense, subtracted. And provide 5% RDD on debtors. This is new RDD. This will be calculated on 48,000. After deducting new bad debts, we have debtors now 48,000. New RDD 5% will not be calculated on 50,000. It will be calculated on 48,000. So new RDD 2,400. This amount of new RDD will be deducted as expense. Prepare opening statement of affairs, closing statement of affairs, and statement of profit or loss for the year ended 31st March 2012. For Mr. Suhas, we are required to prepare statement of affairs, opening and closing. Opening as on 1st April 2011, closing as on 31st March 2012. Debtors opening 45,000, closing 50,000. Asset side, debtors 45,000, 50,000. Next, creditors, opening 60,000, closing 70,000. Liability side, creditors opening 60,000, closing 70,000. Computer opening 60,000, closing 1,20,000. Asset side, computers opening 60,000, closing 1,20,000. 10% government bonds, opening nothing, closing 10,000. Asset side, 10% government bonds, opening nothing, closing 10,000. Bank overdraft, opening 80,000, closing 40,000. Liabilities, bank overdraft, opening 80,000, closing 40,000. Next, motor van, opening 80,000, closing 80,000. Assets, motor van, opening, closing 80,000. Next, furniture, opening 10,000, closing 10,000. Asset side, furniture, opening 10,000, closing 10,000. Next, stock, opening 65,000, closing 80,000. Asset side, stock, opening 65,000, closing 80,000. Next, cash in hand, opening 2,000, closing 8,000. Asset side, cash, opening 2,000, closing 8,000. Next, bills receivable, opening 60,000, closing 80,000. Asset side, bills receivable, opening 60,000, closing 80,000. We have recorded all assets and liabilities in statement of affairs. Let us close this statement to find out opening and closing capitals. 1st April 2011, opening balances of assets total is 3,22,000. From this 3,22,000, if we deduct creditors and bank overdraft, we get opening capital 1,82,000. 31st March 2012, total of asset side 4,38,000. From this 4,38,000, if we deduct creditors and bank overdraft, we get closing balance of capital 3,28,000. So by preparing statement of affairs, we have calculated opening capital 1,82,000, closing capital 3,28,000. Let us proceed to prepare statement of profit and loss account. For Mr. Suhas, we are required to prepare statement of profit or loss for the year ending 31st March 2012. We are required to first start with closing capital as on last date of financial year. By preparing statement of affairs, we have calculated closing capital 3,28,000. Closing capital as on 31st March 2012 is 3,28,000. On 1st October 2011, he withdrew 40,000 for personal use. This is one information of drawings, cash drawings. Third adjustment says he had also withdrawn 30,000 for rent of his residential flat. One more drawings, 30,000. This will be also added. Closing capital as on 31st March 2012, 3,28,000. To this we have to add drawings for personal use 40,000, rent of residential flat 30,000, 40 plus 30, total amount is 70,000. This will be added to closing capital. It is 3,98,000. From this we are required to deduct additional capital introduced by him during the year. In this problem, there is no additional capital is introduced. Less opening capital as on 1st April 2011. We have prepared opening statement of affairs. We got opening capital 1,82,000. From 3,98,000, if we deduct opening capital 1,82,000, we arrive at 2,16,000. This will be called as profit before adjustment. To this we are required to add income and gains. First we have interest on drawings rupees 2,000. Clear amount is given. We are not required to calculate. Interest on drawings 2,000. Next income we have 10% government bonds which were purchased on 1st October. So there is 6 months lapsed since purchase. So we are required to calculate 6 months accrued interest on government bonds. That we have calculated here, it is 500. This is income receivable. This will be added. Accrued interest on 10% government bonds. Principal amount 10,000 multiplied by rate of interest 10% multiplied by 6 by 12 to calculate 6 months interest. It is rupees 500. These two incomes 2,000 and 500 will be added. It is 2,500. Profit before adjustment 2,16,000. To this amount we will be adding this 2,500. Two lakh 16,000 plus 2,500. It is 2,18,500. Now next step will be deduction of expenses and losses. Expense adjustment number 4, depreciate furniture by 10%. Furniture, here we have of rupees 10,000. Opening as well as closing is 10,000. So there is no any addition or subtraction during the year. 10,000, 10%. So it will be 1,000. %10 depreciation on furniture, 10,000 multiplied by 10%, it is 1,000. Write off 2,000 from motor van. Return off, that is depreciation on motor van, 2,000. Allow interest on capital 10% per annum. This interest will be on opening balance of capital. Opening capital is 1,82,000. On this 10% will be calculated. During the year, there is no additional capital introduced. So interest will be charged only on opening balance of capital. Interest on capital, opening balance of capital 1,82,000 multiplied by 10%, it will be 18,200. Rupees 2,000 is written off as bad debts. New bad debts 2,000. Provide 5% RDD on debtors. Closing debtors are 50,000. 2,000 new bad debts if we deduct, balance remains 48,000. New RDD 5% is calculated on this 48,000, which comes to 2,400. Debtors closing 50,000 less new bad debts 2,000. Debtors balance 48,000 on which 5% RDD is calculated. It is 2,400. We have recorded all expenses. Let us add them. We have 2,18,500 after adding incomes and gains. Now we are required to deduct expenses from this figure. Net profit for the year 2011-12. Finally, we got 1,92,900. In this question, we learn how to give effect to adjustment of accrued interest on investments purchased during the year. Thanks for watching this video. Stay in tune with Ekeeda and subscribe to our channel Ekeeda. Thank you.